So when I heard about the fact that you can get a holding corporation and, move money around to purchase real estate with that, my mind just like exploded. Welcome to another episode of Here We Grow. Today I'm very excited to have my good buddy Brody Taylor on, who is an accountant with, is it called Wilkinson?
Wilkinson and Company, yeah.
Wilkinson and Kingston, yeah. And so today the big focus that we want to talk about, because we get this question a lot, and I referred the question to you anyway, so I figured we'd cover it, is should I incorporate as a realtor? So as of, 2 years ago? Give or take?
Yeah, about 2 years ago. I don't know the exact date the legislation passed and realtors became allowed to incorporate. And I can't wait to tell the listeners about the benefits of it.
So it's kind of a confusing process too, because when I first looked at it, it was a lot of information. I made the decision to do it after, talking to you. There was one kind of key point where I was like, it was like, listen, weighing the scales, and then all of a sudden it was like, oh yeah, that makes sense, which we'll talk about later. But so I guess the first thing is, what are the general benefits and pros and cons to incorporating? Let's start there.
All right, so I'm gonna start with the dollar figures because that's what everybody loves. So yeah. I just did a quick little we have our tax programs at work, and I just did a quick tax estimate if you were to incorporate versus not incorporated. The taxes owing on $100,000 earned if you were not incorporated is $28,000. If you're incorporated, it's $12,200.
Right.
So it's $15,960 less taxes paid on that $100,000 that you can keep in the company to reinvest into your growth.
Right.
Then if you go to the higher level, so there's a $500,000 small business deduction is in the corporate tax rate, which is 12.2%. So if you were not incorporated and you earned $500,000, your taxes would be approximately $233,000. Where if you're incorporated, your taxes are only $61,000.
Yeah.
So it's a $172,000 difference. Now, I forgot to do my disclaimer, but this is not tax advice. Right. These are facts, but before you use any of this information to proceed with anything, I highly recommend you either consult me or another professional accountant, just to better learn your situation. I'm sorry. So that's number one is the tax deferral. Gives you the opportunity to keep so much money in your bank, $172,000 extra dollars in your bank to reinvest in your company and grow rather than giving it to CRA to invest it however they invest it.
Right.
The next one is succession planning. So when you incorporate, there's shares. And those shares are, as long as they're qualified small business corporation shares, they're eligible for the lifetime capital gain exemption. So when somebody passes away or goes to sell their corporation, you sell those shares and up to, it's like the first $900,000 gain can be tax-free if the shares qualify.
Right.
Whereas if you were to have another business, like if you had a construction business, which that's not the same situation, but if you weren't incorporated, when you sell, you're deemed to sell all the assets, which triggers these crazy capital gains and crazy taxes owing. So that's another. And then the third is it just does a little protection of the personal assets. It keeps your business and you separate. A lawyer can better touch on exactly how it protects you, but that's another benefit.
So, and I'm going to try to because this is a constant way that we communicate is dumbing it down for me. Because I think it's important to cover too why somebody wouldn't want to incorporate. And from my understanding of this whole thing is if you want to make, $500,000 and you want to spend as much of that as possible on your lifestyle, then it doesn't really make as much sense to incorporate, because when you're taking it out, you're comparing the personal taxes to corporate taxes. When you're taking that $500,000 out, you're at a higher tax bracket, but you'll have more money to spend because it's left the corporation, which is where you can spend it on personal stuff, right?
Yeah, exactly. So that's exactly what I said. The disclaimer, you need to consult a professional before you decide to incorporate, because just like you said, if you're just draining all the money out, you're essentially just wasting money on, because you have to issue T4s and T5s for your payroll and stuff with a corporation. You have to file a T2. Yeah. There are extra filing requirements. It is a little bit more costly.
Yeah.
So if all you're going to do is take all the money out and not take advantage of that low tax rate and pay it all personally anyway, then there is no point in incorporating.
If you want to make $5 and live off $250, then you shouldn't probably incorporate. But if you want to make $5 and you can live off of $1, then you can save your money in your corporation. Correct me.
I mean, even $250.
Yeah.
So that's about the threshold. Once you hit around 250, the tax rate goes to like 53% personally. So even if you're keeping 250 in the corporation, that's only exposed to 12.2% as
Right.
opposed to 50%. So you're still keeping like 30% more of it to invest.
Right. Okay. So at what point, like, in your opinion, when a realtor is looking at this, at what point should they start to consider incorporating? Is it when they reach a certain income threshold? Is it right away as soon as they get licensed? Because sometimes it takes them a couple of years to earn more money. But I don't know if it's one of those situations where you'd rather be looking at it than looking for it, because sometimes you get, I'm sure you have realtors come in where they're starting to make all this money and they're like, I need to incorporate now. And it's almost like it's too late.
Yeah.
Like, is it ever too early or?
It definitely, I would not recommend, like once you hit not revenues, but net income threshold. So after expenses, if you're at about $100,000, I would say that's when it's time to really start thinking about it and sitting down with somebody and mapping out what your goals are. And the other thing to consider, in a real estate, it might not be quite as much of an issue. But if you don't incorporate and you buy a whole bunch of assets, right, and then you do incorporate, we have to do. It's called I don't want to be wrong.
This
so
one.
there's an election.
Let's say this one form.
Yeah, there's a special election where you can transfer all those, but you have to file that election, or else it's deemed to have been sold from you to the corporation. You would have to pay personal tax on it.
Right.
But we can file an election, but there's just a little extra cost.
Right.
But I don't think that is like, I would recommend waiting till you build your client base and really establish yourself. And like I said, if you're starting to make $100K a year, then you really should start considering incorporating to save some money so you can grow that to $500K a year and then on.
So what are kind of like the first steps in setting up a corp? If somebody wanted to do that, they sit down with you. What do those kind of first steps look like?
Yeah. So the first step would be you would sit down with us, an accountant, and we would. So if you have like a wife, is she going to be active in the corporation? So there's shares that we issue, common and preferred shares. I won't go into too much detail. Yeah. But we will sit down.
Keep it nice and simple for the realtors watching.
I'll go in detail if you want to sit down with me and learn all about it. But we'll sit down with you. We'll ask what the plans are, what the plans is for 50 years down the road, so we can put the share structure in place for succession planning, et cetera. That the shares are in there, just the planning for the future, just for tax planning and all that.
Yeah.
I just got lost.
So no worries. Yeah. So okay. So then once you're setting it up, obviously, because that's the whole reason you're incorporating.
Then you got to go.
Plan, right?
We will send we will set up the share structure, how we want the whole corporation set up, and then we will send it to a lawyer, and then a lawyer will file the articles of incorporation, and I should add, you don't need a lawyer, an accountant. You can just go online and you can create a corporation. But like the average person knows nothing about shares or anything. Yeah. So I definitely do not recommend that, but it is a process. But I definitely would recommend talking to one of us and then contacting a lawyer, and then we'll work together to get it.
Yeah. So, I mean, I strongly believe in, paying people what they're worth. And, somebody that does this every single day is going to be able to put your best interest at heart, obviously. Obviously, it's the way I feel about my industry is like, to have a good realtor, it would cost you a lot more in the long run to not have a good realtor, just like it would cost you a lot more to not have a good accountant structure this properly or a good lawyer structure this the way that you need it. And like you said, understanding how you want this to benefit you in the long term, because everybody has different goals, right?
Exactly.
And through our conversations, there's a lot of my goals that are like super, super big. And you're like, well, most people would do this. And when we talk about my goals, you're like, okay, well, that doesn't make sense for you, right? Yep. So which brings me to my next thing. When you're setting it up, you're obviously looking at either doing dividends or salary.
Yeah.
So can you talk about kind of like the difference, pros and cons of those two?
Absolutely. Yeah. So when you're a corporation, you have the option. So if shares are issued to you, then you can be paid dividends. And so the difference with dividends are dividends you pay. So if you receive a dividend, you get a dividend tax credit. So dividends are taxed at a lower tax rate personally. But the con of paying a dividend is that you don't get a deduction from your corporate tax rate. So that's how come, like, there's the dividend tax credit, and there's a whole thing about refundable taxes, which is too high level on that. So we're not going to go into that on dividends. And then the other option, and also the good thing with dividends is you don't have to pay CPP. Where if you do not incorporate, you cannot like pull yourself out of CPP. You are required to pay the $5,000 whatever it is a year at the end of tax year. Where with dividends, you can elect not to pay CPP. But the con is of a T4 contributes to your RSP contribution room. So if you issue yourself a T4, you pay a higher personal tax rate, but you get the RSP contribution room and you get the deduction from your corporate tax income. So that's like, those are the real big differences. And it's like, I know we've had lots of people say, well, I'd rather invest the money myself than give it to CPP, so they pay dividends. So we have a lot of situations like that. But then there's other people who are planning, so you need RSP room. So then you want your T4s.
And the other simple fact is like the one benefit that I saw to a salary, which is it's just easier. Like you set it up where it's every single month you're getting a certain amount of money. I've talked to a lot of realtors that do the salary thing because it's like one less thing to think about. We have enough going on, thinking about pulling out dividends whenever you need money is kind of a different process than, somebody who's got it set up where it's a salary. They don't even have to think about it. The money's in their bank account, whatever. It's one less thing to think about, but
we have a lot of scenarios where we do have people, they just take out a monthly salary. And so what we do is we get to the CPP limit so that they get their CPP because they want to contribute. But then after that salary at the end of the year, we can say, here's how much money you made. Do you want to declare a year-end dividend bonus? And then we can issue dividends at the end of the year sort of deal. So, yeah. But I would recommend, we always recommend, so there's like I said, you need to sit down and say what you want. But typically the best structure is, it's so dependent on situation, but some salary, some dividends, and then you take what you need to live, but then you keep the rest of the money in that corporation and you reinvest that to your growth, and then you can start taking out bigger salaries and bigger dividends as you grow.
And this is why it's important to sit down with an accountant. Well, I'm going to put your number.
That's the other thing I meant to say, is it is way easier to just do it right from the start than if you try to do this yourself and 6 years down the road. It is such a nightmare trying to deal with CRA or anybody or trying to get share ledgers. It's just, I would highly recommend just get it right. It does cost a little bit, but it is, in my personal opinion, completely worth the investment.
Well, so you said something to me yesterday. You're like, I would so much rather have somebody say, when we tell them what they owe for taxes, say, that's it, as opposed to like, are you kidding me? Where am I going to find that money too, right?
Yeah. I've had a couple times where literally I've had some people almost cry and say, how am I going to pay that? And I've had other people go, that's it. And I've had people cry when they owed less, but just because other people are like earning more. So even though they owed more tax, they thought it was nothing because they were used to paying so much more. And that's the type of thing where sitting down with an accountant and incorporating, if it's right for you, it's an amazing thing.
That's the biggest thing we talk about in real estate a lot is like, it's, my dad's he says this all the time. It's like, it's not always about what you make, it's about what you keep. And what he's mostly referring to is, in real estate, there's a high overhead with a lot of stuff that we do, right? Like, you've seen our write-offs. There's a lot of stuff that you have to pay for, right? In order to, run a successful real estate company. So it sounds great that you made all this money, but would you actually keep after you, spend all this money? And I think that is completely relative to and extends to, how much you paid in taxes. How much can you actually reinvest in your company to keep your growth going, as opposed to, paying taxes on it. And obviously you're paying the taxes anyways down the road is, what I'm sure the government of Canada would say, right, is down the road you're going to end up paying that regardless, but you can use it to further, feed your growth right now. And I think it's great. If, like you said, as soon as you're past that 100K threshold, like, it just makes sense to me to do it. Absolutely.
Like, I mean, it's hard to think of a reason why you wouldn't. Other than like it makes complete sense in a lot of situations. But like I said, please contact a professional so we can evaluate your situation before you go ahead.
Unless you need the Ferrari and the yachts and everything, you need to live high. But also, it's like build your business first and then get that later.
Oh, right? Exactly. If you want all that stuff, you need to invest in you first. You can't be investing in a Ferrari before you invest in yourself. So keep that money in and make the money work for you. I like that statement right there. The best investment you could ever make is in yourself. Absolutely. The one thing you talked about yesterday too when we were chatting was, and it's so funny because I've said this before, is like, the way that the Canadian, income tax works is as you start to make more money, you get taxed higher. So people have said like, why would I go make another, X amount of money because I'm only going to be taxed anyways. So you were going to touch on that today. You said. Yeah, I just wanted to talk on the personal tax system that we have super quickly, because like you said, people always say they refuse to work overtime because it just costs them money, and that is just simply not the truth.
So true. Brent's nodding his head and laughing behind the camera.
Yeah, so
have you said that before?
We have what's called a graduated rate estate. So that means my first $20,000 gets taxed the exact same as yours. My first $100,000 gets taxed the same as yours, right? So I have it right here. These are estimates. It changes the tax percentage every year. But your first $45,142 is 20% tax. So then from $93,656 to $98,040 is 37.91% tax. So from those in between those two, you only pay that
same amount of
37
money.
exactly. And then as you work your way up, so then any income over $220,000 is taxed at 53.53%.
Just
so
the
it's
income above
graduated
that.
rate, so it's
Yeah.
made to be even, right? So
Yeah.
every single person pays the same amount of tax on the first level of income. While granted, working the overtime does cost you maybe 53% of tax, you're still keeping 47% of it. So you're not losing money by any means.
Yeah.
So anybody who says that is very wrong.
Yeah.
And I
There
just
you go.
wanted to clear that up because I
Yeah.
hear it way too often.
Yeah.
I also had a couple, so when people are running businesses, we come across a lot of common mistakes and just a lot of little things that cost people money that just simply didn't need to happen. The first is installments. So if you owe over $3,000 in taxes at the end of the year, you're required to remit installments. And so CRA sends you these vouchers, and most people just ignore them and never pay installments. And then you just pay your corporate tax bill at the end of the year. But then what people don't realize is you're getting charged installment interest. So if you don't make those payments, CRA is charging you interest on it. So even though you make payment on time, like say you owed $50,000, you paid it by your deadline, you still get charged installment interest, which I've seen that be like up to $1,500 in a year before. So the one thing I always try to stress is to pay those installments because they're like you've already said it, they're getting it anyway eventually.
Yeah.
Like you are gonna have to pay them the money.
Yeah.
So why not give them less of it and avoid the installment interest and just pay the installments? I know it sucks giving CRA money.
Yeah.
But it's better to
never
give
gets
them
easier,
it now than give them more later.
Yeah, true.
Is the way I look at it. Another one is, so if you have taxable sales of $30,000, you are no longer considered a small supplier and you are instantly registered for HST. Like you are deemed to register for HST. So even if you're not collecting HST after $30,000 revenue, CRA can say that no, 13% of those revenues are ours because you're not a small supplier. You owe us that.
Right.
So then a lot of people, so it's just something people don't know is if you have $30,000 in revenue and it's a taxable supply, you likely have to be registered for HST. You should talk to an accountant and discuss your situation. But it's very likely that you should be registered for HST and you have this liability that you have no idea about.
Yeah, as soon as you get your real estate license, you should be registered for HST. Like your plan should be to make more than
Absolutely.
that anyways,
you
right?
should not be incorporated. But even if you're not incorporated, like if you're just running your own business,
yes, right,
you still have to register if you reach over $30,000. And the other thing, so with real estate, you don't have a lot of startups typically, but if in your situation you do, you have to be registered for HST to claim the ITCs paid. So say you built a big building, I guess maybe a building's not because there's special rules, but if you bought a big machinery or something for your business, sorry, I just lost my train of thought.
Yeah, you're just talking about HST, registering for HST.
Right, so if you don't register for HST before you buy that $100,000 asset and there's $13,000 HST paid on it, you can't claim it if you weren't registered for HST.
Right.
So before you make big capital investments into your business, you should really consider if it's worth registering for HST now so you can get that money back. It's like, because then you have to start collecting HST, but like likely the chances of getting the ITC back to the HST you collect is going to be better and it's going to work out. So you should. But that's, again, it's so dependent on situation. But this is why it's important to talk to somebody who knows because there's so many little ins and outs, and there's so many little things to know that can save you money.
Did you have anything else that was like a common thing that people go through?
Payroll. So a lot of people, when they sign up for payroll, they don't really realize that they have to make payments to CRA monthly, and there's requirements. So you can't just pay somebody. You can't just give them money and then that's it. Like you have to make monthly or quarterly or annual, depending on what CRA signs you up as, remittances for payroll. And if you don't, you get charged interest and penalties again. So that's just another thing think that's about all I had.
Okay. So the one last thing I wanted to touch on is my favorite part about the real estate. Was there something else? You got it.
Well, no, I have tax planning here, but that's
Yeah.
if you come down and sit with us, we've touched on that.
That's what you do, yeah.
That's what we do for a living.
The last thing that I wanted to talk about, which was my favorite part, and when we sat down the first time I talked about incorporating, my mind just like exploded. So it's, you know, the way that you can start off, like instead of paying. So what my goal in this whole business is, I'm never going to get creative. I tell people this all the time. I'll never create the amount of wealth that I want to create from selling real estate. I'll get it by owning it. And obviously that's what we tell our clients too. If you don't believe in your product, you shouldn't be selling it. But that I'll never create that type of wealth from selling it. I'll create it from owning it. So my goal was, okay, how am I going to make as much money as I can selling real estate so I can turn around and buy real estate? So what I had to do was, you know, pay myself as much money as possible before I had the option of incorporating, pay personal taxes on it, and then go buy real estate. But because of the way that the corporation works, if you own other corporations, those corporations can help each other out depending on how you structure it. So when I heard about the fact that you can get a holding corporation and, you know, move money around to purchase real estate with that, my mind just like exploded. So, or if you were going to start another business, then you can still do the same thing. So it was like, before paying personal taxes on it, you can have your corporation help your other corporations, you know, build your wealth, and regardless of what it is you're investing in. Like you said earlier, if, you know, the best investment you can make is in yourself. So if you're making another investment in yourself in a new business, regardless of what it is, there's tax benefits to owning a corporation as a realtor, you know, as it is, right? So
yeah. So you just want So holdcos, like you said, it's a way to separate your businesses, way to protect assets from each other businesses. And like you said, if you want to fund another one, I wrote this down. It is a Section 85 T57 election, and so
write that down.
In the industry, it's considered a cash strip, is what we call it. But basically, so Canadian-controlled private corporations can pay a dividend to another Canadian-controlled private corporation, and basically you can have the tax deferred so that it doesn't trigger tax. There's a thing about dividend refunds and stuff. Again, detail. This is why we need to sit. But I just got lost again.
Yeah, you're transferring corporation to corporation. Like, so you don't have to pay personal. If you're going to start a new corporation, you don't have to pay yourself personal tax and then, you know, pay a bunch of tax. It's deferred. So instead of paying a higher percentage, you're paying the corporate percentage, and then you can use that money before it's paid personal tax to go do something else with another corporation.
Exactly. We can transfer it tax free from one corporate as long as they have to be like a Canadian controlled private corporation. So it has to be a special entity, but that's what we mostly deal with. But essentially you can move $200,000 from one company to the other, and there's no tax implication. All you have to do is file the T2057, which is a Section 85. And then another thing with a holdco, so I've talked about the qualified small business shares and how there's that lifetime capital gain exemption. For shares to be eligible for that exemption, 90% of the assets owned have to be used in active operations. So if you have $1 million of cash sitting in your bank, and that's not considered used in active operations. So that puts you out of the threshold. So to make companies eligible for that exemption, we'll move money from one company to the other. So then now that company has 90% of assets in active operations, and now those shares are eligible for the lifetime capital gain exemption. And that's why you hire an accountant. Mic drop. Yeah, pretty much.
So I want to wrap this up, dude. Thank you so much for coming on. I wanted to wrap this up by you throwing out your information so that if somebody wants, because obviously, like, we just like scraped the surface of this.
Oh yeah.
So if somebody has more questions about this, what's the best way to get a hold of you? You got a phone number or something, email you want to throw out there?
Yeah, absolutely. I don't give out my cell to everybody. We'll do it now because it's a special occasion.
Now that it's on the internet.
So my cell phone is 613-583-1721. You can reach me by email at btaylor@wilkinson.net. Our office number is 613-634-5581. And I'll leave a couple of business cards here in case anybody wants one. But yeah, feel free to reach out. And I love helping people save money. I love helping people through this process. So I would love to help you.
Thanks a lot, brother.
Thank you.
And
thanks for having me, man.
No problem. And as I wrap up every single episode, I like to say, here we grow.